People often ask me, Warren, if you had to start over today with just a small amount of money, what would you do? It's a fascinating question, and I've thought about it quite a bit over the years, because the truth is, I did start with a small amount of money. When I was a kid, I was saving nickels and dimes. My first real investment was buying shares of Citi Service preferred stock when I was 11 years old. I paid $38 for 3 shares. That wasn't much different in relative terms from someone starting with $5,000 today. So let me tell you exactly what I would do if I had to start over today with $5,000. Not 5 million, not 500,000, but $5,000. This is important because most people who want to build wealth are starting with modest amounts. They're not trust fund kids or lottery winners. They're regular people with jobs, families, responsibilities. They're trying to figure out how to turn a small amount into something meaningful over time. The first thing I want to tell you is this: starting with a small amount of money is actually an advantage in some ways. You might not believe that, but it's true. When you're managing small amounts, you have flexibility that large investors don't have. You can invest in smaller companies that wouldn't be worth my time at Berkshire because we're managing hundreds of billions of dollars. You can move quickly without worrying about market impact. You can concentrate your investments without regulatory concerns. These are real advantages. But you also have some challenges. You can't diversify as much as you might like. Transaction costs matter more. You probably have to keep your job and can't invest full time. You don't have access to the same information or opportunities as wealthy investors. You need to be realistic about these constraints while making the most of your advantages. So here's my plan. If I had $5,000 today and I had to start over, knowing everything I know now, this is exactly what I would do. First, I would not invest that $5,000 right away. I know that sounds surprising coming from someone who loves investing, but hear me out. Before you invest in stocks or businesses, you need to invest in yourself. You need to build your knowledge, your skills, your earning power. That's the foundation. Everything else is built on. If I were starting today with $5,000, I would probably keep $4,000 in a savings account as an emergency fund, and I would spend $1,000 on education. Not necessarily formal education or expensive courses, but books, materials, resources that would help me understand business and investing better. I'd study accounting so I could read financial statements. I'd study business history so I could understand what makes companies succeed or fail. I'd study psychology so I could understand how markets and investors behave. The best investment you can make is in yourself. Your earning power is your greatest asset when you're young and starting out. If you can increase your skills and knowledge, if you can make yourself more valuable in the marketplace, you'll earn more over your career. That extra earning power compounds over time. Someone who increases their income from $50,000 a year to $75,000 through additional skills and knowledge will earn hundreds of thousands of dollars more over their career. That dwarfs any returns you could make investing $5,000 in stocks. I spent my early years reading everything I could about business and investing. I read Benjamin Graham's books, which taught me how to analyze securities and think about value. I read annual reports in business publications. I studied successful investors and businesses. That education was worth far more to me than any individual investment I made early on. It gave me the framework and the knowledge to make good decisions over decades. So step one, invest in yourself first. Build your knowledge and skills. The returns on that investment will be extraordinary. Now, let's say I've done that initial self-investment, or let's say I already have that knowledge. What would I do with the $5,000 from an investing standpoint? I would focus on building my capital systematically. At this stage, with this amount of money, the most important thing is not generating investment returns. It's consistently adding to your capital base. Let me explain the math. If you have $5,000 and you earn 20% a year, you make $1,000. That's nice, but it's not life-changing. But if you can save $5,000 a year from your job and add it to your investment capital, that's more impactful than the returns on your initial stake. So I would focus intensely on increasing my savings rate. I'd live below my means. I'd avoid debt like the plague. I'd save as much as possible from every paycheck. This is what I did when I was young. I lived very modestly. I didn't care about fancy cars or expensive clothes or keeping up with anyone. I cared about accumulating capital that I could invest. I've seen so many young people make the mistake of trying to look successful before they are successful. They buy cars they can't afford, rent apartments that are too expensive, spend money on things that don't matter. That's exactly backwards. When you're young and building wealth, you should live like a student even if you have a good job. Save aggressively, invest consistently, let compound interest work for you over time. If I could save $5,000 a year and invest it at a reasonable rate of return, in 10 years, I'd have a substantial sum, especially with compounding. In 20 years, I'd have real wealth. That's how it works. It's not about hitting home runs early. It's about consistently adding capital and letting it compound over long periods. But of course, you asked about what I do with the $5,000 specifically from an investment perspective. So let me get into that. With $5,000, I would not try to invest in individual stocks right away. The transaction cost would eat up too much of my capital. Even with modern discount brokers, you have to be thoughtful about trading costs when you have limited capital. More importantly, at this stage, I'd want to focus on learning and building knowledge rather than trying to pick individual stocks. Instead, I would put the $5,000 into a low-cost index fund, probably an S&P 500 index fund. I know that might sound boring or surprising coming from me, but it's the right move for most people, starting out with limited capital. An index fund gives you broad diversification across hundreds of companies. It has very low costs. It requires no research or monitoring. It delivers market returns, which historically have been quite good over long periods. John Bogle, who founded Vanguard and created the first index fund, did more for individual investors than almost anyone. He showed that you don't need to beat the market to build wealth. You just need to match the market at very low cost and stay invested for the long term. For someone starting with $5,000, that's perfect advice. Now, while that $5,000 is sitting in an index fund, quietly compounding, I would be doing something else. I'd be learning how to invest in individual securities. I'd be reading annual reports of companies. I'd be studying businesses. I'd be developing my ability to value companies and identify good investments. I'd be building my circle of competence. This is crucial. You need to separate your learning phase from your investing phase initially. Don't practice on real money when you're still learning. Use the index fund for your actual capital while you develop your skills. Paper trade if you want. Keep a journal of your analyses and track how your ideas perform. Learn from your mistakes without losing real money. Eventually, if I develop real skill at analyzing businesses and identifying undervalued securities, I might start investing directly in individual stocks. But I'd only do this if I truly had an edge, if I'd done the work to understand businesses better than the average investor. If I couldn't honestly say that, I'd just stick with index funds. There's no shame in that. Index funds will make you wealthy over time if you save consistently and stay invested. If I did start picking individual stocks, here's how I'd approach it with limited capital. I'd look for very small companies that are overlooked by Wall Street. These are companies that are too small for institutional investors to bother with, companies that might not even be covered by analysts. When you're investing thousands of dollars instead of millions or billions, you can look at companies that big investors can't. I'd look for companies trading below their intrinsic value, companies where the market price is less than what the business is really worth. I'd look for strong balance sheets with little or no debt. I'd look for competent, honest management. I'd look for simple businesses that I could understand. I'd look for companies with some kind of competitive advantage, even if it's just a small local advantage. When I was young and managing small amounts of money, I found opportunities like this all the time. I remember investing in a windmill company, in gas stations, in small insurance companies. These weren't famous businesses, but they were good businesses available at bargain prices. If you're willing to do the work, to read the filings, to understand the businesses, you can still find opportunities like this today. The key is patience. You're not trying to get rich quick. You're building positions in solid businesses at good prices. You're letting those businesses compound value over time. You're adding new capital from your savings regularly. Over years and decades, this approach builds substantial wealth. I also want to talk about what I would not do with $5,000. I would not day trade. I would not try to time the market. I would not buy options or other derivatives. I would not invest in cryptocurrencies or non-fungible tokens or whatever speculative fad is popular. I would not buy individual stocks without thoroughly understanding the businesses. I would not listen to stock tips from friends or social media or television personalities. All of these things are tempting, especially when you're young and eager to make money quickly. But they're also the fastest way to lose your capital. I've seen countless people blow up their accounts trying to get rich quick. They trade too much, they chase hot stocks, they take excessive risks, and they lose money. Don't be that person. Investing is not about excitement or quick profits. It's about consistently making good decisions over long periods of time. It's about protecting your capital, earning reasonable returns, and letting compound interest work its magic. That's not exciting, but it works. Let me tell you a story about compound interest, because it's the most powerful force in investing. Albert Einstein supposedly called it the eighth wonder of the world. He said, those who understand it earn it, and those who don't pay it. That's absolutely true. If you start with $5,000 at age 25 and you add $5,000 a year, investing at 10% annual returns, by age 65, you'll have over $2 million. That's the power of consistent saving and compound returns over 4 decades. You don't need to hit home runs. You don't need to find the next Apple or Amazon. You just need to earn solid returns and keep adding capital over a long period. The problem is that most people can't stick with it. They get impatient. They want results faster. They make changes when they should stay the course. They sell when markets fall. They chase returns in hot sectors. They trade too much. All of these behaviors destroy returns and prevent compounding from working its magic. If I were starting over with $5,000, I'd commit to a long-term approach from day one. I'd set up automatic monthly contributions from my paycheck into my investment account. I'd choose a simple, low-cost index fund, or, once I had the skills, a portfolio of individual stocks. I'd leave the money alone and let it compound. I'd ignore market volatility and noise. I'd stay focused on the long term. This requires discipline and patience, which are in short supply. But they're also your greatest advantages as a small investor. You don't have clients demanding quarterly returns. You don't have a boss questioning your decisions. You don't have regulatory requirements or reporting obligations. You can think and act for the long term without any pressure to do otherwise. That's a huge advantage if you use it properly. Now let me talk about the mindset and habits I'd cultivate if I were starting over. These matter just as much as investment strategy, maybe more. First, I'd be intensely curious about business. I'd want to understand how companies make money, what gives them competitive advantages, what makes some succeed and others fail. I'd read voraciously. I'd pay attention to the businesses around me. I'd think about every company I interacted with as a customer and ask, is this a good business? Would I want to own it? This curiosity about business is what's driven my entire career. I genuinely find business fascinating. I love understanding different industries and business models. I love seeing how good management creates value over time. This isn't work for me. It's enjoyable. If you're going to succeed in investing, you need to develop this genuine interest in business. If you don't enjoy it, if it feels like a chore, you're probably not going to be very good at it. Second, I'd be patient and think long-term in everything. Our society is increasingly focused on the short term. Quarterly earnings, daily stock prices, instant gratification. That's exactly wrong for investing. The best investments take years or decades to compound. The best businesses build value steadily over long periods. If you're constantly worried about short-term fluctuations, you'll never build serious wealth. I've held some investments for decades. Coca-Cola, American Express, these are positions we've owned for 30 or 40 years. During that time, there were years when these stocks went down. There were periods when people questioned these companies. But we held on because we understood the businesses, we knew they had durable competitive advantages, and we were thinking about decades, not quarters. If I were starting over with $5,000, I'd adopt that same patient, long-term mindset from day one. I'd ignore daily price movements. I'd focus on the underlying business fundamentals. I'd be willing to hold investments for years or even decades if the business remains strong. That patience would serve me extremely well over time. Third, I'd be frugal and live below my means. Wealth isn't built by earning a lot. It's built by spending less than you earn and investing the difference. I've always lived modestly relative to my means. I still live in the same house I bought in 1958 for $31,500. I don't need a mansion or a yacht or fancy cars. Those things don't bring happiness, and they consume capital that could be compounding. If I were starting over today, I'd apply that same frugality. I'd drive an old car. I'd live in a modest apartment. I'd avoid debt. I'd save aggressively. Every dollar I didn't spend would be a dollar I could invest, a dollar that could compound over time. Over decades, the difference between saving 30% of your income versus 10% is enormous. The higher savings rate gives you so much more capital to invest and compound. Fourth, I'd focus on continuous learning and improvement. Investing isn't something you learn once and then you're done. Markets change, industries evolve, new businesses emerge. You need to keep learning throughout your career. I still read for hours every day. I'm still learning about new industries and business models. That continuous learning has helped me adapt and succeed over 70 plus years. If I were starting over, I'd commit to reading and learning every day. I'd study annual reports, industry publications, business books, biographies of successful business people. I'd learn from others' successes and failures. I'd constantly work to expand my circle of competence and improve my ability to analyze businesses and make good investment decisions. Fifth, I'd be independent-minded and willing to go against the crowd. Some of my best investments have been made when everyone else was pessimistic or when I was buying things that were out of favor. Some of my best decisions have been avoiding things that everyone else loved. You can't be a successful investor if you're just following the crowd. This independent thinking is hard. It's uncomfortable to disagree with consensus. It's lonely to invest in things everyone else is avoiding, but that's often where the opportunities are. If I were starting over with $5,000, I'd cultivate that independent mindset from the beginning. I'd form my own opinions based on my analysis. I'd be willing to be different if my analysis suggested it. Over time, that independence would lead to much better results than just following the herd. Now, let me address something important. What about using that $5,000 to start a business rather than investing in stocks? This is actually something I'd seriously consider, maybe even prefer to stock investing. When you're young with limited capital, starting a small business can be a great way to build wealth. You have more control than you do with stock investments. You can leverage your own labor and skills. You can often start with very little capital if you're creative. And if successful, a small business can generate much higher returns than stock investments. I started several small businesses when I was young. I had a paper route. I bought pinball machines and placed them in barber shops, splitting the profits with the owners. I sold golf balls that I found at the country club. These weren't sophisticated businesses, but they taught me about entrepreneurship and they generated income that I could save and invest. If I were starting over today with $5,000, I might use some of that capital to start a small service business, maybe a lawn care business, or a cleaning business, or a tutoring business, or a digital marketing agency for local businesses. Something with low startup costs that leverages my skills and labor that solves a real problem for customers. The beauty of starting a business is that you're not just investing capital, you're investing your time and effort. That sweat equity can generate returns far exceeding what you could earn on $5,000 in stocks. If I worked evenings and weekends building a small business that generated an extra $1,000 a month in profit, that's $12,000 a year. That's more than double my initial capital, and it's money I can save and invest to compound over time. Plus, starting and running a business teaches you so much about how businesses work. You learn about customers, about pricing, about competition, about operations. That knowledge makes you a much better investor when you do invest in stocks because you understand business from the inside. Many of the best investors started businesses or worked in business before becoming full-time investors. So if I had to start over with $5,000, I'd seriously consider using part of it to start a small business while investing the rest. That combination of entrepreneurship and investing would probably generate the best overall returns on both my capital and my time. Let me also talk about the importance of developing good financial habits beyond just investing. These habits compound over time, just like investment returns. I'd automate my savings so money goes from my paycheck to my investment account before I can spend it. I'd track my spending to understand where money goes and identify areas to cut. I'd avoid consumer debt like credit cards and auto loans. I'd maximize contributions to tax-advantaged retirement accounts if available. I'd negotiate my salary and look for opportunities to increase my income. I'd continually invest in skills that make me more valuable in the marketplace. These habits might not seem directly related to investing, that $5,000, but they're crucial for building wealth. They ensure you're consistently adding capital to invest. They reduce the drag on your wealth from taxes and interest payments. They accelerate your journey to financial independence. I'd also build relationships with people who think about money and investing the way I do. I've been fortunate to have friends and partners who share my investment philosophy and my approach to capital allocation. Those relationships have been valuable throughout my career. If I were starting over, I'd seek out like-minded people who could be learning partners who I could discuss ideas with, who would challenge my thinking and make me better. You don't want to be around people who are constantly spending and showing off. You want to be around people who are building, saving, investing, thinking long-term. Those peer effects matter enormously for your own behavior and success. Let me also address time frame. If you're starting with $5,000 in your 20s, you potentially have 40 or 50 years for that capital to compound. That's incredibly powerful. Even modest returns compound to substantial sums over those time frames. A 10% annual return over 40 years turns $5,000 into over $200,000, and that's without adding any additional capital. But the real power comes from consistently adding to your capital base. If you add $5,000 a year at 10% returns for 40 years, you end up with over $2 million. That's realistic and achievable for most people who commit to saving and investing consistently over their careers. The key is starting early and being consistent. Time is your greatest advantage when you're young. Don't waste it trying to get rich quick or doing things that don't work. Just start saving and investing, even small amounts, and let time do the heavy lifting through compound returns. Finally, let me talk about attitude and perspective. If I were starting over with just $5,000, I wouldn't feel disadvantaged or discouraged. I'd feel excited about the opportunity ahead. I'd know that with the right approach, that $5,000 could grow into substantial wealth over time. I'd know that my earning power and savings discipline matter more than my starting capital. I'd know that knowledge and patience are more valuable than money. Too many people look at successful investors like me and think they can't do it because they don't have millions to start with. That's completely wrong. I started with small amounts. I built wealth slowly through consistent saving and sound investing over decades. Anyone can do the same thing if they're willing to be patient and disciplined. The wonderful thing about America is that the opportunities are there if you're willing to work for them. You can educate yourself. You can save money. You can invest in businesses. You can build wealth over time regardless of where you start. It won't happen overnight and it won't be easy, but it's absolutely possible. So if I had to start over today with $5,000, I'd be optimistic and excited. I'd invest in myself first through education and skill development. I'd live frugally and save aggressively. I'd put my money in low-cost index funds initially while I learned to invest. I'd potentially start a small business to leverage my time and skills. I'd cultivate good habits around money and investing. I'd be patient and think long-term. I'd stay curious about business and keep learning constantly. That approach, sustained over decades, would build substantial wealth from that $5,000 beginning. It's worked for me. It's worked for countless others. And it would work for you if you committed to it. The opportunity is there. The path is clear. All it takes is discipline, patience, and time. Let me get even more specific about how I'd allocate that $5,000 in today's environment. This is important because knowing the principles is one thing, but actually implementing them requires concrete decisions. First $1,000, I'd keep this in cash as an emergency fund. This might seem overly conservative when you're eager to invest, but it's essential. You need a cushion for unexpected expenses, car repairs, medical bills, whatever life throws at you. Without this cushion, you'll be forced to sell investments at bad times or go into debt when emergencies arise. Both of those outcomes are wealth destroyers. Having cash available prevents that. Second $1,000, I'd invest this in myself through books, courses, and materials that would increase my earning power and investment knowledge. Maybe I'd take an accounting class so I could read financial statements properly. Maybe I'd buy a library of business and investing books. Maybe I'd attend a weekend workshop on a skill that would make me more valuable at work. The return on this investment would be immediate and substantial through increased earnings. Third through $5,000, this $3,000 would go into a low-cost S&P 500 index fund. I'd set up automatic monthly purchases of $100 to $200 from my paycheck. I'd reinvest all dividends. I'd ignore the daily price movements. I just let it compound over time while I focused on increasing my income and saving more. That's the initial allocation. But more importantly, here's what I do going forward each month. Let's say I have a job earning $40,000 a year after taxes, which is roughly $3,300 a month. Here's how I'd allocate that income. I'd spend no more than $800. That might mean having roommates, living in a less trendy neighborhood, or renting a small apartment. I don't care. Housing is the biggest expense for most people, and keeping it low frees up capital for saving and investing. Food, I'd budget $300. I'd cook at home, pack lunches, avoid expensive restaurants. Food doesn't need to be expensive to be good. My wife Susie used to make wonderful meals on a modest budget. I still eat simply and inexpensively today. Transportation, $200. I'd drive an old used car that's reliable but not flashy, or I'd use public transportation if available. I wouldn't have a car payment. Car payments are wealth killers. Other essentials, utilities, phone, insurance, clothing, personal care, maybe $500 total if I'm careful and shop smart. That's $1,800 in total expenses, leaving me $1,500 a month to save and invest. That's almost 50% of my income. That savings rate would transform my financial life. Every month, I'd add that $1,500 to my investments. Over a year, that's $18,000. Combined with investment returns, I'd be building wealth rapidly. In 5 years, even with modest returns, I'd have nearly $100,000. In 10 years, well over $200,000. That's real wealth built from a standing start with no special advantages. Now, I know what you're thinking. $1,500 a month in savings sounds impossible. Maybe you have student loans or family obligations, or you live in an expensive city. I understand. The specific numbers will vary for everyone, but the principle is universal. Spend less than you earn and invest the difference aggressively. If you can't save 50%, save 30%. If you can't save 30, save 20. But save something consistently and increase it whenever possible. I'd also focus intensely on increasing that income over time. I'd look for opportunities for promotion at my job. I'd develop skills that command higher salaries. I'd potentially take on side work in my spare time. I'd start a small business on weekends. Every $1,000 increase in monthly income is another $12,000 a year I can save and invest. This is where being young is such an advantage. You have energy, you can work long hours, you don't have as many obligations, you can take risks with your career. Use that flexibility to maximize your income and savings while you can. As you get older with family and responsibilities, it becomes harder. Let me also talk about specific investment opportunities I'd look for once I had more capital and had developed my investing skills. And remember, in the beginning, I'd stick with index funds, but eventually, if I became skilled at analyzing businesses, here's what I'd look for. I'd look for small, profitable companies trading at low multiples of earnings. These exist especially in unglamorous industries that most investors ignore. Maybe it's a small industrial distributor, or a regional bank in the secondary market, or a company that makes some specialized component for a specific industry. These companies often fly under the radar of Wall Street. I'd read their annual reports and quarterly filings carefully. I'd understand their businesses thoroughly. I'd assess their competitive positions. I'd look at their balance sheets to ensure they're financially sound. I'd evaluate their management by reading their letters and looking at their track records of capital allocation. If everything checked out and the price was reasonable, I'd invest with small amounts of capital. I could concentrate my investments more than I can at Berkshire today. I might hold just 5 or 10 stocks instead of dozens. That concentration, if I'd done good analysis, would potentially generate higher returns than a diversified portfolio. But it would also require confidence in my analysis and tolerance for volatility. I'd also look for special situations, things like spin-offs or restructurings where companies are being overlooked temporarily. When a large company spins off a small division, that division often gets sold indiscriminately by investors who own the parent and don't want the spin-off. That forced selling can create opportunities to buy good businesses at bargain prices. Or I'd look for companies going through temporary difficulties that are fixable. Maybe they've had a product recall, or they're digesting an acquisition, or they're dealing with some short-term issue that's depressing the stock. If the underlying business is sound and management is addressing the problems, these situations can be very profitable. The key is having the knowledge and skills to identify these opportunities and the discipline to only invest when the margin of safety is clear. That takes time to develop, which is why I'd start with index funds and only graduate to individual stocks once I'd proven to myself that I had genuine skill. Let me also address a question I often hear. What about real estate? Should someone starting with $5,000 invest in real estate instead of stocks? Real estate can be a good investment, but it's difficult when you're starting with limited capital. You generally need a down payment of 20% or more to buy investment property. On a $100,000 property that's $20,000 plus closing costs, that's more than $5,000. So it's not immediately feasible. However, I wouldn't completely dismiss real estate. Once I'd built up some capital, maybe after a few years of saving and investing, I might consider buying a small rental property or a house hack where I live in one unit and rent out others. Real estate has some advantages: leverage through mortgages, tax benefits, cash flow from rents, and potential appreciation. But real estate also has challenges. It's illiquid, it requires active management, it has ongoing costs for maintenance and repairs, it's concentrated in one asset rather than diversified. For these reasons, I'd probably still prefer stocks, especially when starting out. Stocks are liquid, require no management, can be bought with any amount of capital, and are easily diversified. If I did invest in real estate, eventually I'd approach it the same way I approach stock investing. I'd look for properties selling below their intrinsic value. I'd focus on good locations with solid rental demand. I'd buy with favorable financing terms. I'd manage the properties well to maintain their value and keep good tenants. I'd think long-term and not worry about short-term price fluctuations. But initially, with just $5,000, stocks or index funds would be my focus. Now let me talk about something that's become more accessible today than when I was young. Access to information. When I started out, I had to go to the library to read company filings and annual reports. I had to subscribe to expensive publications to get business information. Today, everything is available online for free. Company filings, annual reports, analyst reports, historical stock prices, industry data, all of it is accessible from your phone or computer.
This democratization of information is a huge advantage for small investors today. You can research companies as thoroughly as professional investors can.
You have access to the same information they do. The only difference is time and skill in analyzing that information. If you're willing to put in the work, you can compete effectively. If I were starting over today, I'd take full advantage of this free access to information. I'd read voraciously. I'd study companies constantly. I'd build my knowledge systematically. That self-education would be incredibly valuable over time. I'd also use modern tools that didn't exist when I was young. Spreadsheets for modeling businesses, databases for screening stocks, online communities for discussing ideas and learning from others, podcasts and videos from successful investors. All of these resources can accelerate your learning if used properly. But I'd also be careful not to be overwhelmed by information. More information isn't always better. What matters is finding useful information and being able to analyze it effectively. I'd focus on primary sources like annual reports and industry publications rather than getting distracted by news and social media chatter about stocks. Let me also emphasize the importance of emotional discipline in investing. This is something that can't be taught from a book. It has to be developed through experience. When you invest your money and watch it fluctuate in value every day, emotions get involved. Fear when prices fall, greed when prices rise, impatience when nothing is happening. These emotions lead to bad decisions. If I were starting over, I'd work on developing emotional discipline from the beginning. I'd remind myself that I'm buying businesses, not trading pieces of paper. I'd focus on fundamentals rather than prices. I'd think long-term rather than react to short-term noise. I'd be patient when everyone else is impatient and cautious when everyone else is greedy. This emotional discipline is one of the biggest advantages I've had throughout my career. I don't get caught up in market emotions. I don't panic when stocks fall. I don't get euphoric when they rise. I just focus on business value and make rational decisions. Developing that discipline early would serve me extremely well over a lifetime of investing. I'd also avoid certain pitfalls that trap many young investors. I wouldn't try to trade my way to wealth. I wouldn't use leverage or margin. I wouldn't buy things I don't understand. I wouldn't chase hot stocks or trends. I wouldn't listen to tips or predictions. I wouldn't check prices obsessively. All of these behaviors are tempting but destructive. Instead, I'd keep it simple. Buy good businesses or index funds at reasonable prices. Hold them for long periods. Add to them consistently. Ignore the noise. Let compound interest work. That simple approach, sustained over decades, creates wealth. Let me close by emphasizing again that starting with $5,000 is not a disadvantage. It's an opportunity. You have your whole life ahead of you. You have time for compounding to work its magic. You have the flexibility that small capital provides. You have access to information and opportunities that didn't exist in previous generations. What you need is the right mindset and approach. Invest in yourself first, live below your means and save aggressively. Put your money in sensible investments and leave it alone. Think long-term, stay disciplined, keep learning, be patient. Do those things consistently over decades, and you'll build substantial wealth from that $5,000 start. I know because I did it. I started with small amounts. I saved aggressively. I invested carefully. I was patient. And it worked beyond my wildest dreams when I was young. The same opportunity exists today for anyone willing to commit to this approach. The path is clear. The principles are proven. All it takes is discipline, patience, and time. If I had to start over today with $5,000, I'd be excited about the journey ahead. And I'd be confident that with the right approach, that $5,000 would grow into substantial wealth over time.